Yes. Yes, Jim, I am recording this. Okay. Now here's our charts that we were looking at again. Here's our entry. Our stop is going to be up here somewhere close to this green line. First area of resistance, second area of resistance, just partial resistance. So therefore, I just have a cautionary yellow line there. Major resistance is way down here at this red line. Now, reward risk ratio here is a lot bigger. It's going to open up about, hello, right there. That's not too far. It will increase the stop, but reward risk ratio will still be about 3 to 1. About 3 to 1. If anybody does get into a SPY sell, so that means SH, which I'll go over the SH here in a second. It'll look exactly the same to go long. Um, but I saw that Michael had a question, John. Wouldn't we just go long the inverse? Yes, but you always have to look at the main one first. The inverse is just the inverse. It's like a mirror copy. So you have to look at the original. The original is SPY. Yeah, so you can't just go, okay, look at SPY, then go look at, sorry, you can't just go look at SH without studying SPY first because the SH is just a mirror copy. Um, you should not make any decisions on any of the inverses whatsoever without looking at the original. So anyway, it's going to break down. If you do get in this trade, you have to stay in. You just have to try to protect your risk, get stop move to break even as soon as possible uh, by following the rules, and then you just have to stay in it because you have to let the gaps take you down to where you want to go to. And we'll go over that today about letting the gaps ride you to your exit strategy. Okay, it hasn't really gapped at all in a while. It's strange. This is the first gap since way over here, since 9/8. Okay, that's our 5-minute warning. If you can hear my phone ringing, that is my alarm clock to let me know that we have 5 minutes before the market opens. You should always have alarms set. Okay, so let's look at that trade on the SH, which is the inverse. Usually in the morning before we start, we'll go over more than just one ETF, but I really needed to get across that about gapping, and we're going to go over it in more detail, but okay. Here you can see that we have same thing. Here's where I grab my lines from. Entry. Oh, come on. There we go. Entry is here. Now I could use this most recent here, but we already know it's going to gap, so we might as well use this top area where there's no more resistance after that. See, no more blue lines after these. There's one more, but the main ones are already passed over. Okay, green line entry, 56.16. You can look up here at the top. It's going to be 56.22. So it's just going to gap right over it. Which means stop should be down here. Right there is good. For those of you who are engineers are going to hate me because I just eyeball everything. I don't really get too much into detail about uh, specific numbers. Okay, there's our exit strategy again. You can see it major, sideways, same thing as the other one, just on the other side. Red line, if you studied, you know red line means stop. So here we go. Try to move that over a little bit. Entry here, stop there. First resistance there, more resistance to come here. Red line there. If you get in this trade, you got to buy, place your stop, and you just have to let it go. And you just have to, I don't care if it takes a couple of days to get there, because most likely it will go up, sideways, then possibly back down a little bit, then stop. So you have to let the gap the next day go up to here, and then you're almost close to your exit strategy. Then it should go sideways, back down. Then you have to take the next gap up, and then you'll be at your exit strategy. So today we're going to go over two major things: how to master the gap, and then how to